Greetings, everyone. I'm David Darst, here to give you a recap of the third quarter and some comments about the outlook for the fourth quarter. As you know, risk assets came under pressure in the third quarter. One of the reasons was the rise in interest rates. The July 26th meeting of the Federal Open Market Committee, that was the last time they raised interest rates. And since that time, equity prices have come under pressure and bond prices have come under pressure as yields have been rising. In particular, many of the growth and tech stocks, which have basically been connected to and linked to low interest rates as rates have been rising, because these are considered to be long duration assets, they've come under pressure. Specifically, NASDAQ was down well over 3% in the third quarter. You've had inflation. It has come down slowly. It is persisting. It has not yet reached the target of 2% that the Federal Reserve keeps reiterating and emphasizing and confirming that they are resolute. They're firmly resolved at this point to continue with that as an objective. Right now, I think another surprise that I think contributed to the rising interest rates has been this strength in the economy. No recession. Our thought has been that a recession would probably take place next year, 2024, and it would be somewhat of a mild recession. And the first Fed interest rate cut would probably come sometime around the middle of 2024. So you remember we entered this year, 2023, expecting a recession, expecting rates to get cut quickly, and they really have not done this. We've had earnings have been mixed. In some places they've been disappointing, other places they've been surprisingly good. So they definitely have been mixed. You take, for example, the reaction of investors to let's say Microsoft and Google. Microsoft reported $27 billion, $26.9 billion to be exact, of operating earnings. That's earnings before interest and taxes for the third quarter. They were very well received, but the stock only went up 1% following that announcement and that release of their third quarter earnings. Google, which is Alphabet, as you know, on the other hand, they too had very, very solid, strong results. However, their cloud business, as you know, they're competing with Microsoft Azure, and they're, of course, competing with the leader, which is Amazon Web Services. And you have a new entrant in the form of Oracle coming in. So you have four people competing for this cloud business, and that's connected in some ways to the artificial intelligence usage of the cloud. And Google's results were fine. However, their cloud business was not measuring up. The stock dropped 9.5% that day, and it was 9.9% down for that week. So you have the not disappointing earnings, but earnings are starting to come under some pressure. Core disinflation, which is after you take out energy and food prices, is on the way down. But as I mentioned a moment ago, it's still above target. I think the Fed is looking at labor costs and the strength of the labor market, which does remain strong, and also energy prices. So service costs, labor costs, and energy costs are really what the Fed is focusing on right now. The GDP forecast, the latest forecast of the International Monetary Fund for the United States for GDP for 2023 is 2.1% real growth, and 2024, 1.5% real growth. And that could have a recession, a small recession in 2024's results. We would not be surprised if that took place. Europe, on the other hand, is showing much weaker growth, expected to be up only 0.7% this year and 1.2% for 2024. China is showing expected 5% growth this year, 2023 as a whole. Next year, 4.2%. The interest rate, the pressures on interest rates Number one, you have the Fed selling bonds from its portfolio, about $80 billion per month in what they call quantitative tightening. And they are continuing with that as of this point in time. You have also the humongous, very large, massive amounts of new Treasury issuance as they are running these enormous deficits. And these deficits are being run with the economy not in recession. Can you imagine what they might be when the economy does get into recession? So that is something that is of a concern to us, not only in the short term, but over the longer term about the effect of the heavy bond issuance that's coming in the fourth quarter. What does this mean? It means that sales, profit margins, and earnings are going to likely be under some pressure. The Magnificent Seven, this is your Apple, Amazon, Microsoft, Meta, Google, you know them, NVIDIA, Tesla. These stocks have begun to reflect some of this pressure of rising interest rates. The takeaway that we draw from a lot of this is an ideal time to be thinking about alternative investments. They provide diversification. Alternatives are not stocks. They're not bonds. They are low correlated or uncorrelated asset classes that basically have a portfolio dampening, lower volatility. You get some returns. You get geographical diversification. You get asset class diversification. The old 60% stocks, 40% bonds, classical asset allocation has been being rethought. And we would say you want to basically entertain and encompass and include alternatives in the portfolio. The risk-adjusted returns by adding alternatives tend to be favorable, and you can capture upside and we think limit downside. It also reduces the overall volatility of the portfolio. We like private credit. We would say you want to be very careful and selective in the private credit. Private real estate, you have, I think many operators are looking for capital, and you can supply capital on favorable and attractive terms. Private equity and private infrastructure. So with that, we basically are opening up the portfolio allocation to increased allocation to alternative investments. With that, we look forward to catching up with you soon, and we wish you a great start to the fourth quarter of 2023.